Yeah, and I'm looking at very, very few questions, ladies and gentlemen. Sorry, I need to just increase the font size, nothing else, and then we continue. Yes. All right. So here we are. So simple questions. So how does currency hedging work in international finance? So what I would expect good students to mention here, of course, we know that the word hedging, we use the hedges as a strategy of protecting ourselves. All right. So of course, the word international finance means that we must be having some foreign currency involved. So and if I'm the one here, I will be able to even quote examples of these hedging techniques. Don't do nothing here. This is international finance. So now you can mention forward contracts, futures, options, and swaps. So how does currency hedging work in international finance? Currency hedging is a strategy used by companies and investors to protect themselves from the risk of adverse movements in exchange rates. It typically involves using financial instruments such as forward contracts, futures, options, and swaps to lock in exchange rates or to mitigate potential losses from currency fluctuations. So what is a sovereign debt? What is a sovereign debt? Of course, Kenya is an independent country. So it means that it can own, in this case, its assets in its name. It can borrow in its name. So when you talk of a sovereignty, a sovereign debt refers to the amount of money that a country's government has borrowed, typically through issuance of securities to finance its operations. This debt can be domestic, borrowed from within the country, the one that we borrow by using our bonds. We float bonds in the market here, treasury bills in the market here. All right. Yeah. Or external, borrowed from foreign lenders. Sovereign debt is an important aspect of a nation's economic health, and its management is critical to maintaining financial stability. So we must ensure that any money is borrowed by government, they are used in this case here for what we intended. All right. All right. And I can tell you, like right now, I mean, the government is borrowing just how they feel, and they get, in this case here, a free hand of using that money how they also feel. In most cases, without what I would call, without a plan. Whatever plans are there, ladies and gentlemen, are just what here. I mean, nobody really follows through them very well. Although, of course, there are improvements in government, but I can assure you that still people are able to get their own ways to squander that money. Moving forward, if you look at, for example, like right now, Kenya Kwanza government is looking at getting money from Japan, getting money from China, right? Getting money, in this case here, from these Islamic countries through what we call the sukuk bonds. And the sukuk bonds, they have tried sukuk bonds. Do you know why, in this case here, sukuk bonds? Sukuk like this. Sukuk like this. Sukuk like this. So sukuk bonds, of course, are bonds that are issued on Islamic principles here. Islamic principles, remember the first principle of Islam in terms of money is concerned, is that whatever loan they give, we don't pay with interest. Interest to them is what here is haram. Interest to them is haram. And then number two, there is a lot of being specific. You must be very specific about how are you going to use their money. They don't want to give you money and then you put their money in a club. You put their money in a business that sells pork. All right. So in this case here, they are very, very, they'll follow they have given you money and then they follow how you're going to use it. If you tell them that you're going to build, for example, like 4-floor house, a house which is a 4-floor, which has 4 floors, you must tell them there are 10 million shillings. We need to be building first floor, second floor. I mean, they want you to be very, very specific, and that is why African countries don't like Islamic bonds, because most of our African leaders, including yourselves here, most of your leaders I know, I mean, ourselves in this case, we have a big appetite for theft. We like, in this case, here, stealing. I read some time back here that, especially in Kenya, about 70% of employees in Kenya here go to their workplaces every morning with an intention of stealing. They would want to get something, in this case, the case that they can steal. Could imagine now getting out of your bed. I mean, saying I'm a police officer and you're planning, like, for example, today I'll be able to get, I mean, ladies and gentlemen, When it comes to this sovereign debt, like somebody is asking there whether Eurobond is a sovereign debt, so long as it is denominated there, of course, in case it has been issued by Kenya. That's a sovereign water bond. At the end of the day, sovereign bonds means that they are not tied with the government. They are tied on the country. Regardless of the person who takes over the seat as the president, you have to pay those sovereign bonds. You must pay them. All right. So sukuk bonds, I hope somebody has been able to take note of that. Sukuk bonds are bonds, in this case, which are issued on Sharia laws. Sharia laws. So Sharia laws, in this case here, we will say nothing like what your interest, and then those guys want to know how their money will be utilized. They are very specific on that. Even the terms. So then somebody may ask, how will they gain this Islam people here by giving you their money? They will gain because you get to share profits. So in this case here, where they are following to know exactly where their money has been used, it's because you're going to share with them profits here. So at the end of the year, you say, I've made this kind of a profit. So if I made this kind of a profit, ladies and gentlemen, then you have some revenue share. So assuming, for example, we have in this case here, what we call murabaha. So murabaha, what happens? Murabaha, we must be having a bigger nation and a smaller nation. The land, of course, is the bigger. Do you remember those terms of murabaha, musharaka, muduraba? Yeah, there are bulmal, mudaraba or mudraba. Yeah, so of course, if it's mudraba, if it's US which has given Kenya money on Islamic principles, it means that we shall be able to, so we have in this case here, the one who was given money. And then we have the one who is now doing business with this money. So in this case here, the one who was given money, this Rabul Mal, the rich man. This rich man will have now to eat into the profits that are earned by this business person. So you get your profit share, perhaps 50%. You've given out 10 million. They do business, they generate 2 million. So they give you 1 million, they're left with 1 million. What if in this case here, this person goes outside there to hunt? You know, business is like hunting. You can easily get outside there and you're not able to get any money. You're not able to get any profit. So if you're not able to get any profit, you're making losses, then remember the poor man who is now this businessman. The businessman will not accept, or rather will not absorb any loss. No sharing of losses. The losses in this case here will always be absorbed by the rich man. That is Islam for you. Islam is not about, in this case here, making the poor poorer. Islam is about uplifting. It's about uplifting. In Africa, in Kenya, you go and borrow one day a Shylock loan of say 20,000. And then those guys tell you it is 20% per month. I mean, they will, in this case, just squeeze you to your last blood because you're going to pay the entire interest. And then, of course, you pay the entire principal. And the chances are, even after doing all that, you may even lose the collateral. All right? Islam is not like that. If you get an Islam doing like that, that guy will not go to heaven. They don't believe in trading money. All right? All right? So it will be very important for us also to think about what here, those sukuk bonds. Why is it important for us to have sukuk bonds in Kenya here, for example? Why should we issue sukuk bonds? Because those guys are very, very understanding. Like when the nation is doing very bad in terms of exchange rate, you can say, hey, we have made a loss. So we have made a loss, then they cannot, in this case here, pursue you for anything on top. It's the law. It is in the Quran. All right. So long as, of course, again, you are faithful, you don't take advantage of that. And then every other year, you're saying, I've made a loss. Which loss? You. What are the major determinants of exchange rates in the long run? Of course, in this case here, we have already discussed these determinants of exchange rates will include, in this case here, this concept of difference in inflation rates, difference in interest rates, current account deficits, what we call the balance of payments, public debt. The more the public debt you have, of course, in this case here, during the time of paying this international denominated, currency denominated public debt, you're going to need dollars to pay. You're going to put a lot of pressure on your currency. So public debt, differences in interest rates, current account, public debt, political stability is, of course, a big influencer. Economic performance. Countries in this case that are economically performing very well, they always have stable currencies. And of course, there are people who in this case here hold on to dollars for speculation. Those guys who hold onto dollars here, they're holding onto dollars here. Automatically, they make the dollars to be scarce in the market, and then the exchange rate in this case here changes there. How do balance of payments accounts impact exchange rates? Ladies and gentlemen, remember, balance of payments, we are looking at exports and what here? Imports. If you are a net importer, if you have a deficit in the current account, this will automatically lead to a depreciation of the country's currency because it implies that the country is importing more than it is exporting, leading to a higher supply of its currency in the foreign exchange in the foreign exchange market. I hope, ladies and gentlemen, that is clear. I mean, when we talk of balance of payments, when you have a negative balance of payment, that means export minus imports. You are importing more. Automatically, that one will be destabilizing your exchange rate. Because what are you using to import? You are using the dollar to import. And if you're importing using the dollar, then automatically, during the time of bringing those goods now here, you need more dollars. So the demand for dollar will be high. So the value of dollar then goes up. As the dollar goes up, it of course will have a diverse effect on your Kenya shilling, And that is why if you look at, for example, our president here seems to be knowing exactly what should be done in this case here for Kenya to do what here, for Kenya to go up. He seems to be knowing. That is why in this Finance Bill 2024, they were proposing in this case here, hiking taxes for goods in this case here coming to Kenya. All right. How I wish he gets just very good what here, advisors around him. I think this guy knows exactly what we need. He's the best placed man under the circumstances. You guys may not like my statement, but I'm telling you the truth. He's the best placed guy to be able to handle even most of these things. If Gen Z put in a lot of pressure about, for example, salary reduction for MPs, this is the man to watch. He can easily do something. I'm not saying that he's 100% okay, but I know. Fortunately, there is no way anybody can throw stones to me. You are not anywhere near me. What is the difference between a currency board and a floating exchange rate? A currency board, this is a terminology which the examiner can easily use, ladies and gentlemen, to simply confuse you. Currency boards are basically the fixed exchange rates. There are countries in this case that have just fixed their exchange rates, countries like Djibouti. So $1 will be about 170 Djiboutian franc. All right. So, and then that rate does not change. It remains ever constant. It is on a board, a flat board like that. And then, of course, Kenya shilling is a floating, is on a floating basis here. Nitakwambia Ruto is the best placed. Nitakwambia, lakini kwanza tumalizie maswali. Nitakwambia a currency board is a type of fixed exchange rate system where a country's currency is directly tied to another currency at a fixed rate. And the monetary authority holds reserves of the anchor currency to ensure this peg. A floating exchange rate system allows the currency to fluctuate freely according to market forces without direct government or central bank interventions. Without, in this case here, direct government or central interventions. That already has sunk, ladies and gentlemen. So then what are the implications of a country adopting that fixed exchange rate, a pegged, they call it a board currency exchange rate, or a pegged, you're just pegging like that, or another currency and then you fix it. Adopting a pegged exchange rate system can provide stability and predictability in international trade and investment by reducing exchange rate volatility. However, it can also limit a country's monetary policy flexibility and leads to economic imbalances if the peg is not sustainable due to significant differences in inflation or economic growth between the pegged currencies. Now, ladies and gentlemen, please listen. The biggest concern, if, for example, Kenya today was to peg the currency permanently on the dollar, and then they say we are not moving. Now, automatically, remember the concept of money corporation, international corporation. Through IMF, you guys will be left out. You guys will be left out of the equation, out of the money. You will be able to miss on the loans and any other support, in this case here, from international partners, etc. So, of course, as you peg, we have said there is the advantage of predictability. I mean, as people deal with you, they know exactly that, the dollar is going for this much. But at the end of the day, you are not going to survive very, very easily. Remember, like IMF will come. Like the other day, they were telling us that our Kenya shilling is really overpriced. Remember them, IMF, they believe that the Kenya shilling, we should be having like 200 Kenya shillings in this case here into the dollar. That's what they believe in, given our economic productivity. And they really pushed our government here until we were able to see our government, just allowing, that's quite sad, our currency, in this case here, trading the dollar to the tune of 162. All right? Which would have been very good if we were a net exporter. So also IMF, most of these Bretton Woods institutions, they're not very good to African countries here. They're not very good to African countries, if you ask me. And this is something you should be able to bring out in an exam. They're not very good to African countries. Why? Because they push policies on us, which in this case here, of course, are against our progression as a nation. Because like now, these whatever bills, 2024, whatever, they pushed our leaders to the extent of, us getting a revolution in Kenya. Look at the destruction that these kind of revolutions, in this case here, have in the country, like a whole month, 3 months. Nothing is happening. Just a lot of politicking around. And why are we going through that? I'm so sure if it was not because our leaders were told that this act must pass for you to get 77 billion US dollars. This act must, no. They're destroying. They're against us, in this case here, becoming independent. We are a sovereign state. All right. What we just need is, number one, to put our house in order in terms of reducing corruption. And I'm telling you, we may not even need those loans. Look at, for example, how much do we lose in terms of car parking in Nairobi County? How much, if just car parking fees was to be handled very well in Nairobi, how much should we be earning? In a year, it can be, a lot of billions, a lot of money. All right. So what we need is to organize ourselves. We don't need, in this case here, to have those international partners, in this case here, really interfering with us so much. That is one of the disadvantages of working with this IMF, because they would want to really, squeeze you. That is why I told you yesterday, if these guys are saying that they want us to correct our balance of payments, that we export more, then why is it, since we became independent from 63, why is it that our balance of payments is ever negative? All right. Yeah, corruption is normally budgeted for in our country. If you're able to remove that, I can tell you, Africa, Kenya, best country in the world. Explain the concept of uncovered interest rate parity, uncovered interest rate parity. When we talk of covered interest rate parity, covered. So here, for example, we are making use of these arbitrage opportunities. I've taught you these arbitrage opportunities. All right. So in this case here, we have Uganda interest rate, maybe it's 15%. Kenya interest rate, maybe it's 10%. So then we can easily go and invest our money where? In Uganda, where the interest rate is higher. We borrow from Kenya here and invest this money in Uganda. So that in this case, at the end of the day, we earn more interest there. And then we are able to do what here? We are able to bring this money back home here. Profit earned, we exchange. We get our wealth here, we create our wealth here. So when it is covered, when we talk of covered, then we have those derivatives inside. Whenever we have covered interest rate parity, covered interest parity or something arbitrage, what is covering us will be those derivatives. If it's uncovered, it is only you taking advantage of interest differentials for you to be able to earn your profit, but there is a risk because you're not involving derivatives. You're not involving derivatives. So uncovered interest rate parity suggests that the expected change in exchange rates between the two currencies is equal to the difference in their nominal interest rates. Unlike covered interest rate parity, uncovered does not involve hedging through forward contracts, thus leaving the investor exposed to exchange rate risk. Explain the concept of uncovered interest rate parity. Ladies and gentlemen, remember what I told you here. When we talk of interest rate parity, par means the same. That if interest rates between two countries are the same, we have interest rate in Kenya 10%, interest rate in Uganda 10%, then the exchange rate between Kenya shilling and Uganda shilling will always remain the same. We shall be good neighbors. We shall not be worried about that the Kenya shilling now has gained etc. But we know at the end of the day, that is not practical, because the two nations will have different interest rates, different inflation rates, given the differences in how we are managing the countries. Of course, Kenya is much better managed. Where Uganda can defeat us, Uganda can only defeat us in terms of what here? Food productivity. But I believe Kenya is better managed with all our problems here. All right. So then in this case here, you'll always have differences in terms of what here? In terms of inflations here. And therefore, I can easily make what we call an arbitrage profit, because the exchange rate will keep on fluctuating. I can get my Uganda shillings later on. In this case here, I sell. So there is an opportunity for arbitrage profit. But you see, this arbitrage profit, when you are making cross-border transactions, you can easily lose. And therefore, in this case here, you need to have some forward contracts. You need to have some derivatives, some hedging tools. All right. Great question there. So in this case here, we need to have, so when it is interest rates arbitrage, but in this case here with some what here, with some derivatives, we call it covered. There is something covering us to ensure that we don't make what here, we don't make a loss. So when it's uncovered, then you are prone to those exchange rate risks here. You can easily make what here? Losses, which reminds me, some time back, we used to make good monies in this foreign exchange business. We used to just run here about 20 years ago when I was still young. I think I've done very many businesses here, more than anyone here. So we used to buy dollars there, and they were selling, in this case here, them right in town bureaus here. All right. Used to be a good business until the central bank brought these, how can I call them? I mean, where in this case now they're able to regulate. All right. So we started buying dollars there, and then coming to town, you get like they're almost the same, a little cents difference. And in most cases, when you are exchanging, you are making what you're low. So it's not that when you start doing this, taking advantage of these interest rate differentials between countries, you're going to make profits. No, there's a possibility you can make losses. So then if there is a possibility you can make losses, and then you say, hey, let me just protect myself. So if I'm protecting myself, then that will be a covered interest rate arbitrage. If it doesn't have any protection mechanisms, then that automatically becomes what here? Uncovered. Great. Now, somebody is asking about this very good question here. Why can't we have one currency in Africa? I mean, it is quite sad that you move from here, you go to Zanzibar. I mean, they can't accept the Kenya shilling. You really struggle with the Kenya shillings over there. You must get a place to change. And when you change, of course, most likely you'll make what here? Losses. You go to Uganda again here, given these cross-border transactions that we're getting ourselves in, why can't we have one currency in Africa? One currency in Africa. Of course, divided attention. Museveni would want in this case here too. Once you have one currency, then that means like the United States of America. this one currency. So at the end of the day, we'll be drifting towards unifying the entire continent under one governance structure. Many people may not want that. Many people may not want that. And somebody has been able to answer that. That is why Gaddafi, despite his very good deeds, he was killed. People may not even want Africa to come together that way. They still have interest in mining. They want to steal from us. They're stealing, in this case here, from Zambia, Congo, etc. They do not want Africa to. If you look at, like the other day, I was in, I keep on forgetting these, there is part of Somalia that is very, very peaceful. Somaliland, yes. I mean, you go to Somaliland, the kind of things those guys are doing there, they are crazily good. If you get, for example, a pumpkin, just pumpkin, coming from those areas, you won't believe it, a pumpkin cup, or even charcoal harvesting. I mean, you wonder. And that is why such kind of a country, of course, now the other bigger side of, I mean, people not want it to be stable. Because if it's stable, then they will not be able to, I mean, harvest. And I'm sorry to report here, like I was told here, even KDF in Somalia, we are stealing their things. Very, very bad. Very, very bad situation. We need Africa to be stable. We need Africa to be stable so that we can create jobs. I mean, if Somalia was to be stable, I can tell you it can absorb so many people to go and work there and there. I mean, we need a stable continent, a stable continent. Yeah, great. I can see you guys are, and I like people really look at this continental and intercontinental politics. We need to know these things because at the end of the day, we'll need emancipation for the poor African girl, for the poor African boy. What are the risks associated with currency mismatches on a company's balance sheet? On a company's balance sheet, you know, one of the ways of hedging, if you remember, hedging, is to have your business invoicing customers using some currency. I mean, for example, I always give you this example of Panari Hotel, where you have, in this case here, Panari invoicing all its customers in dollars, and yet it is in Kenya. So then if that happens, they'll be receiving dollars from customers, but I believe these guys are still in need of Kenya shillings here, and they're still buying some things here locally. So at the end of the day, you have what you call a mismatch. At the end of the day, there'll be some exchange to be done. And when you have those kind of exchanges being done, like on a daily basis, you want to buy Sukuma Wiki here locally, you are changing every day, that mismatch will make you get into losses. It doesn't have to be like, you can't have like a balance sheet having assets, in this case here, in Kenya shillings, and then it is basically on how we are doing business, So currency mismatches occur when a company has assets in one currency and liabilities in another. This exposes the company to exchange rate risk, where unfavorable movements in exchange rates can lead to financial losses, especially if the company cannot pass on the costs or adjust prices quickly. These we have seen already. Number 10, how do exchange rate movements affect a country's trade balance? Exchange rate movements impact the trade balance through the relative prices of exports and imports. A depreciation of a country's currency makes its exports cheaper and the imports more expensive, which can improve the trade balance if the price elasticity of demand for exports and imports is favorable. Conversely, currency appreciation can worsen the trade the trade balance. How do exchange rate movements affect a country's trade balances? And you told me, ladies and gentlemen, you guys are right. You told me, Mwalimu, when the Kenya shilling, for example, depreciates, who are normally happy? When the Kenya shilling depreciates, like we have 160, 170 Kenya shillings in this case here per dollar, exporters will always be very happy because they're exporting goods, getting dollars, and then they come and find the dollar price in Kenya here being high, being good. They feel good. But you see, this concept of balance of payments can only, in this case, impact on you favorably if you are a net exporter. If you're a net exporter and then your currency is depreciating, then that is very, very good because you'll be very happy. But if you are a net importer and you are so fixated on what year, you are so fixated on importing stuff. Like Kenya, there is no way, I don't think in Kenya there is a way we can really operate without what year, without importation. Kenya, we are a net importer, and it will take us more than 20 or even 30 years to really come to realize that we need to sober up and start producing our own things. If, for example, we are importing, things like toothpicks, eggs from Uganda here. I don't know what happens to our Wangiges here. Wangiges here, we used to have very good eggs from there. Nowadays, in this case here, we are not producing. We are giving away our jobs there. All right. I think something is not happening. Something is not happening really. So we need to sober up. Yeah, Iraq, I've never been there. But I'm told, yes, it's a very, very good country. Like this week, we have some meeting of IGAD. I'm one of the consultants of IGAD. I'm the one who is doing for them IPSAS implementation. And we were able to get IPSAS compliant. Good opinion from KPMG last. So now they have a very big meeting in Iraq somewhere there. Onions are from we risk. Oh, okay. What I know, like with Somaliland, like what we are calling M-Pesa here, their M-Pesa there is way, way better. And I'm told they started that M-Pesa long time ago. All right. And something like, for example, like dollar. Everybody is making use of dollars there, which is very bad because that brings me to my next question that we call dollarization. Dollarization here. What are the benefits and drawbacks of dollarization? Dollarization refers to the process of a country adopting a foreign currency, typically the US dollar, as its official currency. Of course, the benefits include reduced currency risk and lower interest rates, as well as the potentially greater economic stability. However, the drawbacks include the loss of independent monetary policy and the signage, the profit made from issuing currency, as well as an increased vulnerability to external economic shocks. I'm not able to pick very good advantages and disadvantages. Ladies and gentlemen, when we talk of dollarization, like even in Kenya here, we have reached this place. That time I went to Vipingo, Mombasa, I would want, of course, to have my retirement home around those areas. The Vipingo Ridge, they're telling me that they can't sell to me land in Kenya shillings. It has to be in dollars. That's what we call dollar. So it means that they are not trusting our Kenya shillings. And then when I asked around, who are the sellers? These are just normal Kenyans here. I don't want to mention places, but you are a Kenyan, but you don't, in this case here, want to sell your things in Kenya shillings. So once in this case here, we have a higher affinity for the dollar. That even, for example, in Kilimani here, some places here, they will ask you to pay in dollars. All right? That's what we call dollarization. We start, in this case, shying away from our currency, would want, in this case, here, to have the dollar ruling here. Then what are the key disadvantages? Number one, we shall make the dollar to be what here? Expensive. That is, sending away our currency now. Because now we have a higher demand for the dollar locally. You're forcing everybody now to start looking for the dollar. All right. Of course, the other disadvantage is that when now America is in problems, automatically you'll be in problems because the dollars will be very scarce. So you can't be able to run away from this global these global financial shocks. All right. Yeah, dola inauzwa kwa street kama miraa. Hassan, kumbe umejui maneno. Hassan umejui maneno. But now the problem, Hassan, how comes then you guys are accepting those international interferences where they come and kind of bribe one family And then, I mean, you create havoc around. Why can't you guys know that there are problems there which are being brought by external people? External people. All right. So, ladies and gentlemen, I would want you to look around your past papers, and maybe in the next 15 minutes, because we have these sessions are normally 1 hour. Are there questions that you would want us to address, General? I think I've really covered very many of these questions, but if you feel that we have a few questions that you would want us to look at, the floor now is open. The theory questions, because I would want today to be the last day for tackling these theories. We have done so much. We have done so much, a lot. So please look at your past papers around. Try plotting those questions here so that chip in before I give my final remark. And as Teacher David did, I also think I need to do prayers. But you see now me, I'm finishing on Tuesday. So I can't pray today. I can't pray today. You have to type the question. You have to type the question, but summarized, of course. Aaron Chumba, objectives of IMF that we have done severally. That we have done severally. So then I would want us to take on Belinda's question in relation to financial risk management. Explain 4 advantages of a plain vanilla currency swap with monthly delivered compared with a strip of forward contracts. Then that begs the question, first of all, what is this plain vanilla swap? What is a plain vanilla swap? What is a plain vanilla swap? Let's start from there. Somebody give me an answer. You guys have access to AI possibilities. I know you can easily give. What is a plain vanilla currency swap from the name? I remember this question. So many guys in this case here told us that, you know, Mwalimu, this could be like yogurt. Now we're not taking any more answers or rather any more questions. Let's first of all address the questions we have here. Let's address the questions that we have here first. All of us now, we are putting our minds to the questions that are here. We shall be taking like 5 questions at a time. So now we are answering Belinda's question in relation to financial risk management. Explain 4 advantages of plain vanilla currency swap. So first of all, I would want to know, what are these plain vanilla currency swaps? So I'm waiting for your answers. From the word plain, somebody should be able to explain something there. Great. So I can see in this case here, good questions coming. Somebody is telling me types of trade. How do we terminate swaps? Reasons why rates are not popular with investors. Talk about foreign direct investment. I think, Chumba, you must have missed a class that I've already done. Swapping with another. So Belinda is telling me that plain vanilla currency swap is a straightforward financial instrument used to exchange cash flows between parties in different currencies. Plain vanilla currency swap and strips of forward contracts are both tools used as in financial risk management, particularly for you guys are answering the question, the advantages, but you're not giving me a very good definition of a plain vanilla currency swap. Why is it called plain? 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 Let's start from there. Do research. Do your own research. Why is it called plain? ACCA book has them. Now, ladies and gentlemen, I would want you to really appreciate here, under this plain vanilla, from the word plain, you know, we don't want volatility. We don't want volatility. What we would want in this case here is a situation where we are able to predict our cash flows, for example. So when you talk of a plain vanilla swap, you are basically looking to a situation where you have a loan, which, for example, has a floating rate of interest, floating. When in this case here, the rate of interest goes up, automatically in this case here, your interest obligation goes up automatically. When in this case here, we change a floating interest loan to become, in this case here, a fixed interest loan, like what we are discussing at the pegged. Then in this case here, we have had what we call a plain vanilla swap. A plain vanilla swap. So basically a plain vanilla swap is where we have investors swapping floating interest rates or even floating exchange rates, obligations, with the obligations that are what here fixed in nature. So we go plain. And as Sylvia's told us up here, ladies and gentlemen, Sylvia has given us a very good plain vanilla currency swaps offer simple administration, cost efficiency, reduced counterparty risk, and a better liquidity management compared to a strip of forward what here contracts here. So plain. So we agree with if it's a bank, as in this case, even when we come to you in future, ours in this case will be what here fixed like that. We don't want, of course, in this case here, we know that fixed is expensive because they'll be able to fix this thing very highly there. They'll be able to fix these things very highly there. All right. So in this case, when it's a plain vanilla swap, we expect constant exchange rates. We expect constant rates of interest. This takes every advantage of what here? Simplicity. Simple administration. You won't get in this case into liquidity problems because already you are able to predict your things because of what the plain like that. Very good. Now, ladies and gentlemen, from there is somebody who wants us to discuss the Greek. The Greek. Do you know them? For example, we have the rho. Do you know those things? There are 5 of them. We have rho, we have gamma. Do you know them? Do you know them? Delta, delta, you have to mention them, all of them, before I explain them. They are in the ACCA book. We have theta, yes, theta, theta, theta. I hope somebody is taking those notes there. Like Stanislaus has written there the spelling of theta. T-H-E-T-A, theta. We have vega, V-E-G-A. Is there somebody who is hearing Greeks? Do we have alpha? Do we have alpha? I doubt. Now, ladies and gentlemen, are you able to write down the formula of D1? How do we get D1? How do we get D1? At Varna and Volga, we shall overcome. We shall overcome. Is there somebody who can write down the formula of D1? D1, for getting option, value of a call option. Write it down somewhere there. D1 equals who? D1 equals who? D1 equals who? Somewhere there it has got ln. Somewhere there, ladies and gentlemen, I don't know where, but it has got r. It has got standard water deviation. It has got time. It has got time. So, ladies and gentlemen, when we talk of theta is the time factor that affects what here? Value over an option. Theta for t. Theta for t. Theta like this. Let me just theta. Under that D1, you can see that it's time, isn't it? So one of them is this theta. So we have this theta. So this theta, ladies and gentlemen, this is the time factor. The time factor in evaluation of an option. In evaluation of an option. That is theta. And then in this case here, we have rho. Rho now becomes what here? Rho. Rho becomes interest rate. The interest rate factor in evaluation of what here? An option. Of course, the higher the interest rate, in this case here, the higher the interest rate. In this case here, the higher what here? The higher the value of the call. The higher the value of the option. Interest rate or risk-free rate, whatever. And then we have vega. Vega is the last one that I will be able to explain here. Vega. Vega means what here? Volatility. So volatility is standard deviation. Volatility is standard deviation. So the moment you have those three, then you are good to go. They're just about a description. You don't have to understand delta. Those three are very, very important. So whenever you hear of a rho, R, rate of interest, how does it influence the option? Whenever you hear of a vega for V, volatility, and volatility is what your standard deviation, like that. I hope that is clear. Somehow you guys will be able to run with the ball. Should they give us a question from this area, you should be able to run with the ball. Another question, please don't bring in so many questions. You guys are not following instructions. We're going to take these questions, like 5 of them. Great, I'm looking for one question here. Reasons why rates are not popular with investors. Is there somebody who can give us an answer for that? Reasons why rates are not popular with investors here. Reasons why rates are not popular with investors. Rates are real estate investment trusts. Real estate investment trusts. Why rates are not popular with investors. Why rates are not popular with investors. Now, ladies and gentlemen, first of all, it will be very important for you to know that these real estate investment trusts are quite a new thing to Kenya, to us here in Kenya. For example, if you know these hostels called Kwetu hostels, they're operating on a rates basis, real estate investment trusts, where basically they go value the entire hostel and then they sell, not the rooms or whatever, they sell, in this case, their shares to investors. And then now as a shareholder, you'll be waiting at the end of the year, we look at these children, I mean, how much have they given in terms of rent, etc., what is the profit? And then, of course, we share that as dividends. One advantage the rates have, these rates companies are always pushed to distribute about 90% minimum. They want you to distribute everything. The rates companies in this case here are needed by law to distribute almost everything to the members. That's one advantage. But you see now that is an advantage to a poor man. If you're a poor man, you will always want, in this case here, you are what here, you always want your dividends. Poor men always take up dividends. Rich men, they would want that money to be retained by the company for what we call capital gain. Because if you are paying me these dividends, then you are subjecting me to a higher tax. You know, if it's capital gain, I leave that money to be retained by the company, so my tax reduces. So then I can see some tax inefficiencies in these rates. Why are you forcing the rich people? Like these multinational investors, they want to see, like if it's Kwetu hostels, growing very fast. So they would want to have a situation where most of this money is retained. So the first disadvantage, why these rates are not very, very key, like if it's Kwetu hostels, growing very fast. So they would want to have a situation where most of this money is retained. So the first disadvantage, why these rates are not very, very common, they are not very good for these big investors who would want most of these companies to withhold, to retain dividends here, to retain profits here, to retain profits. Great. Yeah, like what's Dares is telling us here, lack of large pools of rental properties to be acquired by what year rates. I mean, if a rates company was to come to me and tell me, Mwalimu, please give us your house and then we manage it under rates concept, I'll ask them one thing. You know, it's quite, I mean, something that is very, very new. Because if it's rates, that means automatically my ownership in this house will go down. This guy, it's like they're buying this house for me. Not many people will accept. Just like in real estate, do you know now we have what we call sectional properties, sectional titles, where you only buy like just one apartment amongst, say, 40 of them in one big building. So you buy that. So you're given a title deed for that. It's called a sectional title deed. It's a new thing. Yeah, regulatory and tax considerations that I'll give you because, I mean, so many guys would want a situation where their taxes are not going up. Thank you very much, Arbe. Availability of alternative such as treasury bills and what year bonds. If there is anybody who is a firm believer of government investing with government, it's me. I know the advantages of investing in government. whatever small monies I get, and in this case here, we have a government bond being sold, I'll always buy. I'll always buy. And the good thing is that, government bonds, they normally pay interest twice a year. So if you buy like a December 31st bond or January 1st bond around there, then June, you'll get, in this case, your interest, and December, every 6 months they give you. So now what we do as investors, we buy bonds, January bonds, to give you June and December. Then you buy again February to give you, in this case here, July, and next year, January. So you buy bonds on a monthly basis so that by the time you are retiring, you'll be getting what here? You'll be getting, ladies and gentlemen, you'll be getting constant interest every month. Every month you'll be getting something. Now, if I go to put my money in Equator hostels, I can see there are also other investors who are putting up hostels near universities. I am seeing very many other risks. Like, I'm 100% sure, and this is something I'm telling you, in 10 years' time from today, people will not be going to universities physically to study. 10 years from today. That's why I sympathize with Mary University and other universities that have gone around here. They are really building a lot of structures. They're not understanding this Gen Z thing. Most of these guys, I'm telling you, they'll only be coming to school during practicals. So that if you're building hostels here, and around them, what do you think of those hostels in the next 10 years? What do you think of those hostels in the next 10 years? I would rather invest in government because of the plain vanilla. Because of the plain vanilla, I'll be getting my money. Of course, it's a little bit smaller. It's a little bit lower compared to the other returns. But you see, this is constant. And trust you me, ladies and gentlemen, do you know that government bonds pay much better than rental income? Do you guys know that government bonds pay much better than rental income? Are you aware of that? Yes, because if I invest like, say, 40 million in a house, say around where 40 million cannot give me a good house in Kilimani, maybe Kitengela. This house will give me like 300,000 a month, 40 million. 300,000 a month, that will go to Ikienda Sana, give it 10 months because there are months you have to give to taxes and etc. So that is 3 million a year. If I take the 40 million and give it to government, I will be able to discuss with them preferable rates of interest. I can even get as high as 20%. And this is tax-free. That's 8 million. So I get 8 million year one, 4 million in June. I like this thing of June. I like it. June and December, twice a year. So I get 4 million in June. I get 4 million in December. Again, next year, 5 years, I've recouped back my total money. And then in this case here, the 40 million, I'll continue earning this, say, if it's a 25-year bond, all through. And then, of course, the money I get, like nikipata 4 million June, misi mjinga, naeka kuingine, I build a portfolio. Hii rent ni hatari sana. Tunapitianga mambo mengi. Kama kuna rental income, you understand what I'm talking about. Hiyo huwezi niambia ni passive income. Sio passive income. Unakuta kuna tenants who are very bright. And you can't chase them. If you try chasing one of them, unafunga mlango, atakustaki. Na utalipa pesa mingi sana. Mimi mara nimeshapata landlord akikimbiza tenant kwa njia sababu ya rent. Unataka kuniambia hiyo ndio passive income? That's so active. The best passive income ni government bond. The best passive income. Any other income? No. Government bond nikiwa kiwete leo, mimi naendelea tu kungojea pesa yangu inatukua kwa bank. Na connect bank na simu yangu. Wherever niko, mimi nachukua pesa yangu. Hiyo ndio taptengele ya ukweli. Non-liquidity. You are right. If I have Safaricom shares today is as good as money that I have in my pocket. Because if I go to the capital market, Nairobi Stock Exchange, through my agent, of course, I'll be able to get my shares selling on the same day. But go with Kwetu Hostel rates, try to sell at 500. Nobody will buy. I have people in this case even who go to banks to try, in this case here, getting loans on using those shares as collateral. They don't sell, rates don't sell. It's a new thing in the market. Yeah, Hassan, you are a very good student. I don't know how you reasoned about this. If you reasoned this yourself and it's not AI, then you are a very, very good student. Very, very good student. is telling me that the income I will get from the rates in most cases is interest rate dependent, because rates are capital intensive. Most of these guys must, on top of the shares they're issuing out, they must borrow heavily. So when they borrow heavily, and in most cases they borrow foreign currency, when the interest rate goes up like this, in most cases the rates, people don't get nothing, they get zero, they get zero. Thank you so much. I think you have listed many of these things like that. That is for sure. Now I can see why you're using that title, SAR. You know, SAR is the highest. Yeah. So low rental yields as compared to bonds and treasury bills. Great, Ida. What is the process of buying government bonds? If you don't mind, Ida, with your permission, I should be able to take you through this process after exams. After exams, I should be able to hold a meeting with you guys where we discuss about investment. I don't want to be in a situation where very soon you'll be an advisor of how people should be buying these government bonds because you have done financial management and you don't even have a DHOW account, a DAO account with CPK. Right? So if you allow me, I'll be able to have a discussion with this about this with you guys in the future. Great. Yeah, like Sylvia is saying that these affordable houses will make houses cheap. Yeah. So in this case, that's a very big threat to individuals who are doing real estate. But Sylvia, you must be very young. Do you think this affordable housing thing is going to work? It's a good point, but do you think it's going to work? Do you think the government will be building like so many houses for people? Remember already, National Housing Corporation has issued a red flag that even the houses we have, we are not able to sell. Because at the end of the day, I mean, who will be buying those houses now? Because you are telling me that they're doing houses up to 300 houses in a block. I mean, are they looking at how children from those houses will be playing? That thing is like a ghetto. They're making ghettos. In this case, in the next 10 years again, those will be the most useless kind of houses. You know, when you put together 300 homes, there are things you have to look at. Many, many things you have to look at, which I'm so sure these contractors are not seeing. Unsold houses, you can see already Aaron Chumba is raising that. White elephant, yes. Discuss real estate theory. Yeah, if you've ever seen the police houses, I mean, those guys really need these houses. They need these houses. They build for Kenya Police first. Great. So in this case, again, it's a funny model. It's a funny model. Yeah, our president, I think, messed a little bit, because if you are contributing this housing levy, and then when it comes to buying the house, that levy cannot even give you any kind of a rebate. I mean, then what is this? I mean, we are doing that. I'm contributing, and then I'll be buying this house at the same rate with somebody who never contribute, or even the one who never contribute at all will even have a better, even if it's social security. I mean, there are things that must be looked at. Kibera resettlement project never worked. It's not easy. It's not easy, especially the ones that I've seen these guys building here at Ngara. 300 houses in a single compound without a playing field. That would be a theft zone. I mean, I'm looking at how the entire model will work really. We'll need, in this case, scholars to do a lot of research on the same. There should be basic standards. Because again, who are you bringing to these houses? Very young couples, very young families with young children. So if you're not providing playing grounds, no nursery schools nearby, we'll basically be congesting our town setups. It will be a disaster. So there is a lot of town planning which is needed. All right, ladies and gentlemen. So somebody wants me to discuss so many things there. So what I think we need to do, ladies and gentlemen, is a simple thing. What I think we need to do, ladies and gentlemen, we have to agree, because I'm so sure some of you are going to work. Some of you are going to work. So then allow me in this kind of 2-3 minutes commercial break before I tell you what you're going to do. You know, you'll get students in this case here, for example, we have year 10, we have 23, we have 45. So tell these students to do something very small here, to add this in Excel. When you tell them to add in Excel, they'll come and start, in this case, you're telling you equals. Then they start pressing sum. They see summation is there. And then now they start, in this case here, doing like this, control shift down. And then in this case here, now they can come and say enter. Then we have another one here, for example, 24, another one, for example, 45, another one, for example, 56. And then you tell them add here. Now, at least this shortcut they know. They'll come and tell you, well, but I have added here. If I've added here, what I need to do is to throw this to the right, to throw the ball to the right. So in this case, how do I throw the ball to the right? Control right. So in this case, that one they know. But a good student in Excel, a good accountant, ladies and gentlemen, a good accountant in Excel cannot do that. A good accountant in Excel, for example, will come and highlight these two if you want to do the two. And then you say straight Alt equals. When you say Alt equals, it works magic. Alt equals, all right? You know, there are things I normally see people doing until I laugh. The other day I got my boss somewhere, and I really made him laugh. He's an Indian, and Indians are good. I don't know why this guy was doing something like this. So you can see in this case, like we have this word, which in this case is very big for this cell. Very big. I mean, a word which doesn't fit in a cell. So utapata jamaa, na ni mingi, hiki tumeja, sa jamaa anaenda moja moja, anapanua hii. Anaanza panua, anasema alafu anafurahi. Hata hajajaa vizuri. Tena anaanza kupanua ingine. Apana. Somebody should be able to teach you guys this Excel. Excel is a beautiful thing. Where you come and, for example, highlight the entire sheet. Because I'm an accountant, I'm a finance director. In one sheet, I've got so many things. I would want to be able to read everything. So once I've been able to highlight this entire sheet, I will simply come to any in between here. And then I double click. Majina inafunguka yote mara moja. Inafunguka yote mara moja, inaingia na mzuri. And this is the kind of Excel that I will be teaching you guys from basic. You'll be surprised. Wacha niulize swali kusema ukweli kabisa. Iko mwanafunzi mwenye amekuwa kabla nifunze hii. Niambie ni ukweli. Iko mwanafunzi akitaka kuexpand sana anapanuanga moja moja. Niambie ni ukweli. Iko mwanafunzi anapanua moja hivi, anapanua moja hivi. Niambie ni ukweli. Niambie ni ukweli. Niambie ni ukweli. Bila kudanganya mwalimu wenu. Bila kudanganya mwalimu wenu. Kunaye. So ladies and gentlemen, this is why I want you to start doing this Excel. And the Excel that we are doing here is more advanced. You'll be surprised. The kind of things that we can do with Excel, ladies and gentlemen, ladies and gentlemen, we can do a lot of things with Excel. And I showed you this example yesterday. So I'll be able to move from very basic to advanced Excel within 2 weeks. You guys in this case here will be what here? Will be experts. So I showed you this kind of a thing. For example, we have here, if I click here and say control down arrow, you'll be able to see here, this has got 15,121 rows. With lots of nothing, if I say go back home here, you can't even understand what this is. Price, etc. So this is what we call big data. When you give me this kind of big data, then I'll be able to come and say control shift right arrow, control shift down arrow. I highlight the entire 15,000 rows, and then I'll be able to come here and say insert. I insert a pivot table. New worksheet. I say, okay. So when I'm here, ladies and gentlemen, what do? I know the years for me. Of course, you can have them as rows. Years, I'll come and throw this in columns. Very easy. The product types, I can come and do this in the rows. And then I want to evaluate, for example, volume, like that. See, I've been able to prepare what we call a dashboard. So this dashboard, I'll be able to now use it for decision making, even for, tracking performance, key performance indicators. So I know, like, if it's alcohol, 136, 168, 194, hawa jamaa wamejikaza hawa. Hebu tuangalie bread. Aya, nikiona ya itoshi, what do? I like this because I'll come and fix a pivot table like this. I can now collapse this very easily. Alafu ni create space. Nisongesha hii hapa. Now with this, I can do what we call slice and dicing. So I can come and slice, for example, here. For example, I'm interested in tracking cosmetics. Let me uncheck all of them first. Maybe beverages and the coffee. All right, I say, okay. So you can see I'm slicing this down to beverages and coffee, and the table has behaved, beverages and coffee. I'm slicing them down concurrently. I can also come and slice down, for example, E2014 Ajaisha, so I can uncheck this. I check the years I want. So remember, I'm doing this in a board presentation like that. You can see now it is 2 years, 20. So I'll be able to tell this beverages guy, you're trying, but not very much. I mean, look at your manager, the other manager who is doing coffee. Look at the increase in 20. So here we are able now to monitor what we call performance now very well. All right. I'm telling you, as an accountant, without these things, it will be a very, very big problem to you in future. And we are here offering ourselves to teach you this thing for just 1,000 bob. It costs in this case here over 80,000 outside there. And now you are being taught Excel for accountants by an accountant himself, who is me. So I'm happy because yesterday I saw like 19 students have paid. I would want to welcome. It should be all of you joining this. And don't ever think that you know Excel. If you think you know Excel, the Excel you know it wrongly. Trust you me. There are very few people who would be knowing the Excel that I would want to teach them. So there are two advantages. You'll know Excel for your workplace. And then number two, you'll be able to know Excel for business data analytics. Why people fail business data analytics like 4 or 5 times, it's because of their poor Excel skills. When you're good in Excel, then chances are you'll easily pass your BDA round 1. So it's 1,000. And remember, we have other courses like iTax, where we teach you, in this case here, how do you do tax obligations, how do you calculate them, and how do you file. We have the computerized accountants, that is Sage, QuickBooks, etc. But I recommend you doing 3 of them at the same time, if possible. That is Excel, QuickBooks, and maybe iTax. So if you're doing 3, again, you get another saving. You will pay 2,700 for the 3. So that offer ended, but we extended it. We extended the offer, and we hope you guys will be able to take advantage of that. So we have our number. Of course, you would want to join me for that class. Give me work to do. Uskachoke na ECP hapana. So this is our number for inquiries. 0719 525,000. And then, of course, our pay bill, because the ninjas who like swinging with a pay bill. Pay bill is 62 42 839. Account, you write short courses. Short courses. So 3 courses, 2,700. You can also do 1 course like the Excel. Excel is mandatory. Otherwise, thank you so much. Oh, what is expected in BDA paper? So in BDA paper, we'll be calculating, for example, the WACCs. We shall be calculating, in this case here, goodwills, etc., but now in Excel. So we'll be teaching you these advanced papers, but in an Excel environment. Refresher course, we said yesterday, you only pay 50%. So long as either you have our certificate. Again, that is very bad because we are restricting it to our students only. Yeah, you will access the videos. You'll access the videos on LMS, yes. Timetable for the next few days. Okay.